The history of banking unfolds as a dynamic narrative, tracing the evolution of financial systems across civilizations. From ancient Mesopotamia's temple-based transactions to the Renaissance innovations in Italy, banking has been pivotal in shaping economic structures. As we journey through the ages, from the emergence of early moneylenders to the complexities of modern global finance, the story of banking reveals the ingenuity, challenges, and transformative moments that have defined the intricate tapestry of financial history. Before starting, don't forget to like and subscribe to our channel for more future updates. So, let's start. Globalization 20th, 21st centuries. Globalization in the 20th and 21st centuries has profoundly impacted the history of banking. The expansion of international trade, communication, and technology facilitated the integration of financial markets worldwide. Banks evolved into global entities, establishing branches and partnerships across borders. Technological advancements, such as online banking and electronic transactions, transformed the way financial institutions operate. However, globalization also exposed banks to increased risks, as evidenced by the interconnectedness observed during the 2008 financial crisis. This era represents a dynamic period where banking transcended national boundaries, influencing economies. Great Depression, 1929-1930s. The Great Depression of the 1929-1930s stands as a pivotal chapter in the history of banking. The collapse of stock markets, triggered by the Wall Street crash of 1929, led to widespread economic turmoil. Banks faced a wave of failures as panicked depositors rushed to withdraw funds. The lack of effective regulatory mechanisms exacerbated the crisis. Governments responded with reforms, including the creation of the U.S. Federal Deposit Insurance Corporation, FDIC, in 1933, aiming to restore public confidence and stabilize the banking sector. The Great Depression highlighted the critical role of banking regulations and the need for robust financial safeguards. 19th century innovations. The 19th century witnessed transformative innovations in the history of banking. The Industrial Revolution spurred unprecedented economic growth, leading to the proliferation of commercial banks to support burgeoning industries. Joint stock companies emerged, allowing broader public participation in banking investments. Railways and telegraph networks facilitated faster communication and financial transactions. This period also saw the establishment of the Bank Charter Act in 1844 in the United Kingdom, regulating the issuance of banknotes. The 19th century innovations laid the groundwork for modern banking structures, combining technological progress, financial instruments, and regulatory frameworks that shaped the banking landscape well into the 20th century. Bank of England, 1694. The establishment of the Bank of England in 1694 marked a pivotal moment in the history of banking. Conceived to address fiscal challenges, the bank became the first central bank in the world. It played a crucial role in financing wars, managing public debt, and stabilizing the currency. The Bank of England issued banknotes, becoming a cornerstone in the evolution of modern banking practices. Its influence extended beyond national borders, serving as a model for central banking worldwide. The Bank of England's enduring legacy lies in shaping financial systems, influencing economic policies, and setting precedents for central banking institutions globally. Amsterdam, 17th century. Amsterdam in the 17th century played a transformative role in the history of banking. The city became a financial powerhouse, notably with the establishment of the Bank of Amsterdam in 1609. This institution pioneered deposit banking, allowing individuals to deposit and withdraw funds while issuing a stable currency. These innovations not only facilitated trade and investment but also influenced banking practices globally. Amsterdam's 17th century financial developments laid the groundwork for modern banking systems, leaving an enduring legacy that shaped the evolution of global finance. Renaissance, 14th, 17th centuries. The Renaissance, 14th, 17th centuries, marked a pivotal period in the history of banking. Italian city-states, particularly Florence, became centers of economic and cultural resurgence. Banking families like the Medici played a significant role, providing financial services, fostering trade, and supporting the arts. Innovations such as double-entry bookkeeping and bills of exchange emerged, enhancing financial practices. The rise of banking institutions extended to Northern Europe, influencing the Dutch in Amsterdam and the Fuggers in Germany. This banking renaissance not only stimulated economic growth but also laid the groundwork for modern financial systems, shaping the trajectory of global commerce. Medieval Europe, Middle Ages. Medieval Europe during the Middle Ages witnessed nascent developments in the history of banking. Italian city-states, including Venice and Florence, saw the emergence of moneylenders and early banking practices. Ecclesiastical institutions facilitated financial transactions, and fairs became hubs for trade and banking activities. The Knights Templar introduced innovations like letters of credit and promissory notes. However, usury laws constrained lending practices. The Medici family in Florence notably rose to prominence, establishing a banking dynasty that influenced European finance. Despite limitations, these medieval banking foundations laid essential groundwork, setting the stage for the evolution of financial systems. Ancient Greece and Rome, 600 BC, 300 CE. Ancient Greece and Rome, 600 BC, 300 CE, witnessed early advancements in the history of banking. The Greeks engaged in financial transactions, with temples serving as depositories and bankers offering loans. The Romans, influenced by Greek practices, established the argentery, early bankers dealing with money and exchange. As trade flourished, financial instruments like promissory notes emerged. The Roman government operated the aerarium, managing state finances. These ancient banking practices laid foundational principles for later financial systems. Although distinct from modern banking, the economic structures in ancient Greece and Rome contributed significantly to shaping early financial institutions and monetary practices. Ancient Egypt, 2000 BCE. In ancient Egypt around 2000 BC, rudimentary forms of banking began to surface, marking an early chapter in financial history. Temples served as de facto banks, safeguarding valuables and grains. Agricultural surplus, a primary economic asset, was stored in temple granaries, and loans were extended to farmers against future harvests. Scribes played a crucial role, recording transactions and managing accounts. Ancient Egypt's approach to finance showcased an early recognition of the need for secure storage and lending, influencing subsequent developments in banking. Ancient Mesopotamia, 3000 BCE. Ancient Mesopotamia, circa 3000 BCE, witnessed pioneering developments in banking, marking a significant phase in financial history. Temples acted as early financial institutions, playing a central role in both religious and economic spheres. They served as secure repositories, safeguarding commodities, precious metals, and other assets. The introduction of a rudimentary form of interest reflected the growing complexities of economic transactions. While distinct from modern banking, these practices established foundational concepts like secure storage, lending, and interest, influencing the evolution of financial systems in ancient civilizations and beyond. As we wrap up today's video, the story of banking is a fascinating tapestry woven through time. If you enjoyed this exploration, don't forget to like and subscribe to Money College for more historical insights, and comments below about how you see the history of banking, and stay tuned for our next exciting video. Thanks for watching, and see you in the next one.